People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook, and each week Charisse and I sit down here, have a little fun, and we also talk a little finance. We talk about retirement here because that's what Charisse does. She helps people get ready for and get into and support you through retirement. If you are seeing that on the horizon, you're a couple of years out, maybe you're really close, and you see what's going on in markets right now, and it worries you a little bit. You haven't found that person to help you through this important time of your life. That's why we have this show. Charisse, how are you doing today?
Oh, I'm doing great. It's a Mother's Day weekend, right? It's a special weekend for all of us moms and all of us women who have moms. So it's a time to make sure you're all cooking dinner for your moms, bringing them flowers, or remembering your moms if they're not here anymore, right? Because moms have a big job in this world.
Yes, indeed.
Right? Moms cook, they clean, they take kids to the soccer games, they load up the car, they take kids to the dance. We're sometimes the makeup makers, right? We're the sewing sewers.
You are the logistic people that make the world go around.
No doubt. We mentor, our kids, other kids, and you know what? Moms typically take care of themselves last.
Yeah.
So if you're going to consistently do that, then you better take care of your moms first today. And moms, you let them take care of you first because they owe it to you, right?
Well, Charisse, you have talked a lot about your dad in the past and the whole idea of Zinnia Wealth and the flowers. Your dad was a landscaper. He did a lot of work in that area, and that's kind of where it comes from. So we know a lot about your dad. I mean, he had a big influence on you. But tell me about the influence of your mom. I mean, financially speaking and every place else. Tell me a little bit about what kind of an influence she had on you.
My mom always just made sure we had what we needed. So without my mom, I would have holes in my clothes, right? So unfortunately, my parents got divorced when I was in kindergarten. So that's the sad part. But everything happens for a reason. I truly believe that. And she just made sure, every year she took us to go get our clothing. And not like we were going fancy shopping. I think we had $100 a piece to do that with, but I wasn't doing that with Dad.
Yeah.
That was for sure. When I got my first car, she helped me get my first car. I would not have been able to get a car because I hadn't saved enough money. And she made a deal with me. She said, Reese, if you want this car, this is the price range we need to be in. And I will pay for the first 12 months and then I'll need to take over payments. But she did make me pay for the insurance. So it taught me I got to have a job. I got to pay for my insurance. After 12 months, I've got to take over. And I wouldn't have had a car without that. And my dad was not able to buy me a car. And so, I had a little Honda Civic, right? And back then it was probably $8,000, maybe $6,000 back then. And so, moms somehow make and pave that way. They find a way to get you what you need. I know a lot of single moms out there, a lot of moms that are married. Every story I've ever heard is they will find a way. And that's what is so priceless about moms, because they know you need this stuff, the stuff that you get. If you're blessed enough to get it, it moves the needle forward. It gives you a little hope. It makes you feel special. Moms definitely have a way to make you feel special, right? When you're not sure what you're going to do, right?
Yep. It's important to remember mom. So when you go to Publix today and you see the flowers, grab them because I know it's last minute, but do something, for crying out loud. It is Mother's Day weekend. So we appreciate our moms, and, making sure that everybody's got what they need is really important. And Charisse has kind of built a career on that too, because that's what you do, making sure people have what they need in retirement. So we are constantly talking about that here on the show. And and there's a lot of things that kind of get in the way. And right now, we are in kind of a turbulent time right now. We've got tariffs, we've got a possibility of inflation, we've got a possibility of recession, and now there are people that are talking about something called stagflation. So I'm going to play a little clip here. This is Eric Johnson from Cantor Fitzgerald, big financial company, and he's talking about stagflation. So if you hear that word, we're going to talk a little bit about that here.
We think that the risk reward here for equities is quite poor. As far as the economy goes, the real question is, so we're going to slow, we're going to have slowing growth, and we're going to have rising inflation. And the real question is, how much are we going to slow, and are we going to go negative? So that backdrop right there makes it such that our best case scenario, we think, for the next 6 months is a stagflationary environment.
So he said that about 2 weeks ago, and boy, he is right on the money, because we just got the GDP out, and it is very apparent that our economy in this country is slowing. We're kind of waiting, and because one of the things that happens when like the final domino drops with recession is unemployment, and we haven't seen that yet, but we might.
No.
So what do you say about this, Charisse? Let's talk just a little bit about that.
You know, it's important to kind of just understand some data points here. So stagflation is a slowing economy, right? It's high unemployment, and it's high inflation that's happening all at the same time.
Okay.
And right now, it is telling us that we do not have high unemployment. But I went to a website where you can fact check things and you can see the future of unemployment. And the next round that they come out and they talk about it, there's already 1 million people that are going to be unemployed. So, I mean, the next round is right around the corner, right? So I can see potential stagflation because we're seeing a slow up in growth. I think real estate's going to be a little bit of an issue here come soon. So, you know, we have to be super careful. A lot of people want to hang their hat on the tariffs conversation, which is a big part of it. But right now, you know, I just wish they would have rolled out tariffs a little bit differently, because with a softer landing, and also talked about the tax cuts that are coming. So if you would have talked about tariffs and then the tax cuts coming, I think it would have been a softer landing and we wouldn't be fluctuating so much. So I just think that was done wrong. That's what happens when Navarro kind of gets in Trump's head. But now we got Bessent now doing his thing, and now he's starting to think of you know, different ideas and slowing that. So, but I'll tell you, tariffs historically have had an average percentage, and they'll probably double. And so 100% and 25% is probably not going to happen. So I think Trump will be changing his mind. So that's good news. But I will tell you, I like to look at GDP out there. And last year, Powell lowered interest rates 50 basis points. GDP was at 3.45%, right? And then now GDP projected in future this year is 1.2. So some people say interest rates aren't going to go down. But if Powell did it last year when GDP is at that level and inflation was down, inflation's still pretty down in my opinion, and GDP is even lower, it's almost like we have a forced hand. So now we have to worry about interest rates changing and shifting gears. And I know the stock market has been finally going up a little bit. You know, it goes up and down, went up 2% one day, then went up 2% another day, which is ridiculous. That doesn't typically happen. But at the same time, if you look at the treasuries, they went down to 2.5. So they're already baking in the possibility of Powell lowering rates come May. So a lot of things you have to think about. And I don't want to geek out into the data world. I just want you to know, we're looking at these things. And a lot of you out there are probably like, how does this affect me?
Yeah.
Right. And what should I be doing? Right. And, the biggest part is how does it affect you? You could get unemployed, right? Intel just fired 20,000 people.
Gosh. That's
huge. And a big company like that, because they're slowing growth. So we're starting to see that needle move. And, is your job secure? If inflation stays down, that's fantastic. If you're getting ready for retirement or in retirement, you're probably not going to like interest rates going down, because you can't invest at the bank the way you've been. And bonds aren't going to be as great, right? And so you got to start thinking outside the box. And this is why when you invest your money, you don't have your money doing the same thing, right? A 60-40 is a 60-40 portfolio, 60% at risk, 40% in bonds, safe. These portfolios are not going, in my opinion, going to weather like they did back in the 80s and 90s, where you could just do it, set it and forget it, and no big deal. It's not a set it and forget it world anymore, because we have cannibalism going on right now because you can pull up your Apple cell phone and go into Fidelity and sell your Apple stock, right? That's cannibalism because you've still got that Apple phone, right? And so we don't want that kind of stuff, but it happens, and everything's happened so fast. So you got to have a basket of goodies in your portfolio, and things that are not, what's the word I'm looking for, all correlated. Most people, when we do our portfolio x-ray, Randy, everything's correlated. It's all going to go up at one time. It's all going to go down at one time. You want like 5 to 6 things in your portfolio that do different things at different times, but we're still making money. Some are going to be higher. Some might be a little lower. Some make some money on the downside. So we got to have a negative correlation, a positive correlation, a medium correlation. And that's just with the different ways that your money make money. Because I don't believe in just a 60-40 portfolio. It's lazy. It's boring. I call it the lizard brain strategy. So you have to bake some other things in, because if interest rates go down and now we're having short-term issues at the banks and now you're scrambling, what do I do with my money? I know it's going to happen. You're all going to do that. And then now bonds, the interest rates change there. And you're just like, oh, this is like Groundhog's Day every day. And I don't know the best way to invest. And this is why you do all these amazing and different strategies. And I don't know if you know Ray Dalio, Randy.
Yeah, sure.
He's like one of the best financial gurus in the world. I mean, I follow him. He had great funds. He's retired now, but he believed in 8 different investment strategies. Like literally, this is one of the people I learned how to have all this different types of correlation inside a portfolio. And he had the best portfolios in the country, right? And so, we're just following from the gurus what they did best that made their portfolios really great without doing just the typical boring 60-40 portfolio.
Well, you talk about those big names, and we read about those big names. And just this week, I read that before the tariffs came on, Mark Zuckerberg of Facebook, Meta, he sold lots and lots of stock right before the tariffs took place. Jamie Dimon, who is the CEO of JP Morgan Chase, he sold a ton of stock right before the tariffs took place. I mean, hundreds of millions of dollars worth, okay? So what I take from that is we go, oh, those guys are all rich, and, that's not me. Well, okay, let's look at the concept of it. They saw something coming, and they made a move. Now, we're sitting here talking about possibility of recession, possibility of higher inflation, possibility of stagflation, and that means our accounts could go down. So the concept here is you see something coming, what do you do about it? And what we say here is, as Charisse has just talked about, let's take a look at your portfolio. Let's take a look at your 401k. Let's take a look at your IRA. Let's take a look at your holdings and what you're going to do for retirement and get an analysis of it. And Charisse, as you look at that and you do the portfolio x-ray, you just said what you usually find is people are probably too far on the risk scale. They got too much in the market. So let's just talk about that a little bit. Dialing back risk. What does that mean? For many people, that means go to cash or go to bonds. But that's not necessarily the answer, is it?
No, because what if markets don't crash? What if all this doesn't happen? Maybe it's all hearsay, which I doubt, but where else can you invest when the market goes up and still make that money? So we talked about the 5 to 7 different baskets we want our clients to invest in. We want you to still stay invested in the S&P 500 and the NASDAQ and the Russell, but I want some built-in strategies. You can never lose a dime. So they are out there. We have like a ton of different options for that. And then we have some strategies where you can still stay invested in the market and you be in the S&P 500 and the Russell 1000 and the NASDAQ. And when the market goes down, you can potentially make money on the way down, right? So now that's 2 different strategies. You're still invested in those amazing things you want to be invested in. And then you have, hey, I want a dividend portfolio. So I want the staples of the world, which we have. We have a great dividend portfolio that has a Home Depots and a Walmarts and the Colgates and the Procter & Gamble's, right? That continue to pay dividends on average. And so you have that portfolio, and then you have your growth portfolio. This is your funny money portfolio you're probably not going to touch for 10 years that have the Amazons, the Teslas, right? The NVIDIAs, the Googles, the Microsofts, which are all down right now. So you have this really wide wingspan of a plan that can take you for 30 to 40 years in retirement and actually leave a legacy, because you're tapping into those different dollars in different seasons of your life, whether you're 60, 70, 80, or 90.
Well, if you look at the headlines, you listen to shows, you hear something like this, and you go home and you look at your spouse and she or he looks at you and says, "Well, what are we going to do?" All right, should we be doing something? That's a perfectly logical question. Why don't you bring that question to Charisse and say, should I be doing something? And give me some options on what I might do. And the closer you are to retirement, the more important this becomes. Give us a call. We'll do an analysis for you at no charge. We call it a complimentary retirement consultation. And if you go to our website, you're going to see a box that says exactly that, little gold box. You click on that. We'll ask you for a little information so we can call you. And then the conversation begins. And if we're a good fit, we get a date on a calendar and then start to take a look at the nuts and bolts of it. You can also look at our website, which is zinniawealth.com, ZINNIA wealth.com, or 833-368-3680, 833-368-3680. All right, so Charisse, many of us are saving money in a 401k, and that money has been going in there tax deferred. That means before you pay the taxes. So when you take the money out, you're going to have to pay the taxes. Well, if you don't take that money out, Uncle Sam goes, "Hey, when am I going to get paid?" And he says, age 73 is when we're going to start doing that. You got to start taking that money. This is a time where it causes a lot of difficulties and decision time for a lot of your people. Talk to me a little bit about RMDs, 401ks, IRAs, all that goes into all that.
Alphabet soup.
Yeah, it really is.
Yeah. A lot of people are like, what is an RMD? I know what a 401k is, an IRA, but RMD. So the reason why we're talking about this today, because I've had quite a few questions over the past month. And one of the questions, or it came up a couple of times, is that I have a 401k and I have a couple of IRAs, and I am 72 now and working. Do I have to pull any money out of that 401k? So here's the good news is that if you're working and you have a 401k, you don't have to pull out of that, even though you're in this RMD phase of life. And by the way, the RMD phase of life, if you were born under 1950, your RMD starts at age 72, age 1951 to 1959, you start taking this RMD at 73. So if you're 72 this year and you're born between 1951 and 1959, then you don't have to take your RMD till 73. And if you were born after 1960, you don't have to take it to age 75. So are you confused yet? No, this was another question that came up many times over the last 2 months. So I want people to understand these new rules that just have come out, because it's very confusing, and that's the government for you, right? So, and I tell you these ages, so as we're talking about this 401k and IRA, it's important because you very well might be 73 right now, and you were born in 1952. Mm-hmm. And that 401k, if you're working, you do not have to pull out of it. But if you have an IRA elsewhere, you will have to take a percentage out of it. Doesn't mean you have to spend it. It just means you got to take it, liquidate it, pay the taxes on it, and then do whatever you want with it next. Travel on it, or go reinvest it into like a brokerage account, which will be taxable again. So you got to be careful with that. So those are rules you have to worry about. But here's something else that you think it's so easy to understand, but people are really confused about this, Randy. So let's say you have 3 IRAs and you have 1 401k. So this just came into my office, and they were 76 years old, if I recall. They said, you have to. I asked them, why didn't you roll your 401k to an IRA by now? You know, we're in our mid 70s. And like, I really just like this 401k and I wanted to keep it there. And he said, I heard you on the radio say, hey, you can take all of your RMDs out of one account, or you can take it out of all of them. And he's like, I don't want to take it out of my 401k. And I really just want to take it out of one of my IRAs, because he has 3 IRAs. And I said, well, if you keep that 401k there, by law, you're going to have to take an RMD out of there separately. So that rule doesn't apply to you when you still have a 401k. He went, oh. He said, so if I move it to the IRAs, then I can take it all out of one, or I can take it out of all three of them. I said, yes, it's and or. And he said, okay. And I said, so easy to understand, right? And he was like, yeah, no, this is not easy and important. And that's when I tell people, this is why it's so important to work with somebody who is competent to understand your retirement plan, because the horror stories out there, because this gentleman went to somebody, this is why he called in, and he says, yeah, he said, I don't have to take it out of my 401k. Yeah. And I was like, no, you do. And he's like, I thought I heard you say that. And there's even financial advisors are confused out there.
Right.
Sometimes CPAs are even more confused. It's interesting to me. And he said, well, what do I have to do? Like, my family lives into they're like 100 years old. I was like, I'm 75-ish. He's like, I don't want to have to keep taking these dollars out of these IRAs because I don't even need it. And I said, well, then your next step is to convert your IRAs over to a Roth for the next 10 years, right? So from 75 to 85, we can move all those dollars out of those retirement accounts, put it into a Roth IRA, so that if you do live to 100, the final 15 years that you're going to be living, you pay zero taxes on it. And now you have a Roth IRA that you never have to touch if you never need it. And now your beneficiaries are going to inherit that IRA with zero taxes. I said, if you don't convert it, not only is this tax problem your problem till you die, if you last till 100 years old, but now your kids have their tax consequences. And probably 40% of those dollars, if not more, debating where taxes are down the road, it could be much higher. So your 40 to 50% of your legacy could disappear and go to Uncle Sam.
Wow.
So do it now. He went, oh my gosh. He's like, I'm so glad we talked. Yeah. So, preparing and planning is so important, and prepping. He's like, Sharice, I'm 75 years old and I didn't think I really needed to come see you and prep. He's like, but I sure am glad I did. Because when we did the tax plan for this gentleman, and this is for everybody that comes in, he said, if I roll the IRA, I will actually save money if I live to age 100 years old, if taxes go up just a little bit. And if taxes stay the same, I actually save money for me and my heirs. And he's like, okay, so this is a no-brainer. I've never seen the math. This makes complete sense. So just showing him the math and giving him the confidence and just showing him, hey, here are the rules. These are the rules you have to follow or you're going to be penalized. Was really, really important to him, because it's not, you go to YouTube and do all this stuff. It's really hard to find all this information. And hey, by the way, here in the next few weeks, our YouTube page is going to start having educational segments on RMDs, on estate planning, on all this stuff you need to know. So definitely tune in here come, I would say, June.
Well, it is interesting how we've talked about in the past the 4% rule, which we've kind of blown up in a lot of ways, taking 4% of your money and you never run out. But what's interesting about RMDs is within a couple of years, Uncle Sam is going to tell you need to take more than 4% of your money out. And you're already breaking the 4% rule because Uncle Sam says you have to. So it's kind of a nutty thing. And one of the things that I know that is ongoing support, we talk about that all the time, is Sharice will help you figure out what your RMD is going to be. And then if you say, Sharice, I don't need this money, where can I put this money? How can I make this work for me? There's a lot of options there for you as well. We're coming to the end of the segment. We don't have time to dive into all of that right now, but we want to make sure that this is part of not only sitting down with Sharice and having a tax strategy, but also the ongoing help that you get from Zinnia Wealth. Give us a call and let's talk through it. If everything that you've got is in a 401k, and that describes a lot of us, this is something you're going to deal with. So why not get some help with it? ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says complimentary retirement consultation. Just click on that. You'll be on your way. Or call us 833-368-3680. Again, 833-368-3680. All right, this is kind of interesting as well. Where do you think the odds are better, Las Vegas or the stock market?
Really?
Maybe you own that. I mean, let me tell you something, folks.
No, don't even do it, Randy.
I have never stood next to somebody who is so good at roulette and so lucky in Las Vegas in my life as Sharice Rivers.
I am not good.
Yes,
Listen,
you are.
You're making me look like an awful person that I gamble every once in a while. I was interviewing Jonathan Kane. We were in Vegas, Journey guy. He's been there from the get-go.
He wrote all All the big songs, yeah.
Yeah, and so the concert was in Caesar's Palace. We stayed in Caesar's Palace, and I woke up, had my coffee in the morning, until Randy, I'm like, we were just walking by the roulette table, and I'm like, hey, let's put a couple of bucks on this green double green. And it's not green double green, it's zero double zero.
Right. 0 and 0 0. Yep.
Well, anyways, it came in 4 times, and I just kept piling it up. And then I walked away. I walked away with my money.
That was good.
Then we went in and we did the interview, which was amazing. Right?
Yeah, I've seen you do this on more than one occasion, so you're
okay,
really
you've
good.
seen me do it twice, so I am a lucky ducky. Full disclosure. Okay, move forward. I am lucky. But here's the deal. This is a risk discussion. Randy.
Very risky. Very risky.
And are you better to invest? You asked the question in Vegas or in the stock market.
All right. So,
well, it depends if you're looking at the long term or the short term game. But whether it's long term or short term, you're always going to lose in Vegas, because when you lose, you can't ever make it back unless you pull more money out. In the stock market, if you're doing the long game, if you lose, right, what do we have? We have our magnificent 7 that are down. We have Microsoft down 10%, Google down 20%. I don't know, Amazon's down like 8, Meta's down almost 20, Nvidia's down like 30, right? All these stocks are down, but if you hold them, you don't have to sell them for income, and you focus on the 10-year plan, it's going to come back. So yeah, investing in the stock market is a better strategy than investing in Vegas. So I'll answer your first question.
All right. Okay. So I looked at the odds here. We all know that the house always wins, right? We'll win occasionally, but in the end, as Cherie says, the house wins, because that's how the game is built. Your chances of winning at table games, blackjack, roulette, and all the different games, or in the slots, are between 3 and 12%. That's your winning edge. So if you've won, congratulations, you really beat the odds, okay? Now, if you invest money in the stock market for 1 year, you have a 66% chance of a positive return. At 5 years, a 76% chance. And at 10 years, an 86% chance
in the stock market
of having a positive return.
Okay.
But the big difference is, as you just pointed out, Cherise, in Vegas, you get paid right away. In the stock market, you got to wait to see your payoff, sometimes all the way into retirement. Not quite as exciting, but sometimes boring is better. I've heard people say in the past, have an exciting retirement, have a boring investment plan.
Right.
So one of the things that people mistake on is, I need to beat the market. I need to match the market.
Right.
I need to have a return of an average of 8, 9, 10%.
Yeah, that's
and
great stuff.
that can really work against you, can't it?
It can. I think we kind of repeat ourselves on different shows, Randy, about we don't have to have double-digit returns. We just need to protect from double-digit losses.
There you go. We should put that on a bumper sticker or something, Cherise. We really should.
Because in retirement, you're not in accumulation phase anymore. You guys are thinking, Cherise, you're nuts. No, you are not. You have to do a mind shift, a mind change, because now you're in decumulation. And I know some of you are like, that sounds awful, but it's not awful. Decumulation just means, hey, we've spent 30 to 40 years saving this boatload of money, and now we're going to live on it. That's all it means. So we're still going to accumulate and make money, but now we're in decumulation because we're living on it. So the investment strategy, the psychology of money changes, and nobody's teaching you why it's so important to change your philosophy, because if you do the hang-in approach, like people did in 2000, 2001, 2002, when the stock market went down 33%, those are the ones that are out of money today because they didn't change their spending habits, and or they have pittance left over, and they had to change the way that they lived in their lifestyle. 2006, 7, and 8, it was an 18-month decline. The S&P dropped 50.1%. Those people, when the market went down for 18 months, you had to crawl out of this hole for 4 years. That means you can't touch your money. So is it what you make or what you keep that is most important in retirement? And I'm going to tell you over and over again, it is what you keep. I am telling you, it is what you keep. And I know most of you listening that are retired, You've felt the pain, and you know what I'm saying. And those people who are just retiring now, you have zero clue because the market hasn't crashed since 2008. So you've been growing. You're like, well, my portfolio went up 400%, right? Okay, yeah, it's been climbing. So now you're at the top of this mountain, and now you got to figure out as you're coming down this mountain, you're living on this money, how to make sure that it lasts for the next 30 to 40 years. And if you do the old school strategy like people did in the 80s and 90s, and you enter the 2000s, that first decade of 2000s, and you didn't change your mindset, you didn't change your plan because you're following outdated strategies and you didn't convert over, yeah, you are going to risk running out of money, right? If inflation continues to rise, or we go through all these ebbs and flows, which historically we've always gone through. So when you're investing your money, it's not what you make, it's what you keep. But did somebody dial in and say, here's your income plan? Based on the next 40 years of your life in retirement, you actually only need to make 2%, and you're not going to outlive your money. Did they show you, hey, you have to make 4%? We got to find that plan that makes 4% so you don't run out of money in your early 80s or early 70s. Or are you that person that we have to make 7%? And if you are that person that has to make 7% for the next 30 to 40 years of your lives, you should not. You have no business in retiring today because it's not going to happen. Because when the market goes down, what are you going to live on? And when you have to crawl out of this hole, what are you going to live on? So we have to make sense of the psychology of your money and how it's going to work in this decumulation phase. So we just have to educate you. And we love having money in the market. I'd rather you have more money in the market, but I don't want all your money to lose. Right? And most people in retirement, they don't walk in here, Randy, and say, give me the jiggliest thing you got, Charisse. No, they're like, no, I want to make 7% and I don't want to lose and I don't want to pay you fees. So how do we do this? Right. And so we can make dreams come true, but there's a 50-50. We got to plan this out. We got to make a couple of bucks, and not everything's going to make 7% in your portfolio. Some stuff is going to make 4, some 5, some 6, some might be 30%, right? So we just have to draw the plan out, show it to you, look at it for the next 40 years with an inflation adjustable income plan on top of that, and then see where we land on a pessimistic viewpoint 40 years out. And is there any money left over for long-term care if you go in the facility? And if that's the first spouse, and then the second spouse goes in, do we have enough money left over? And then is there any money left over for the heir? So there's a lot of planning when it comes to a retirement plan.
Sometimes a boring 5% is your best friend.
And it is your best friend.
Yeah. and to know that I could make 5% on my money and I could have a successful retirement. Wouldn't that take some of the pressure off? I got to believe it would. So let's have the conversation. If we find you've got to make 10%, as Charisse says, we got some adjustments. We got some real talking to do. But 2%, 3%, 5%, come on. Maybe that's where you are right now, and the only way to know that is to sit down and talk through it and do some numbers. Give us a call. Give us a look on our website, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says Complimentary Retirement Consultation. Click on that. We'll ask you a couple of questions, a little contact information there, and Charisse's team will reach out to you, and we'll sit down and talk through some of those numbers. You can also call us, do the very same thing, 833-368-3680. So I talked about playing the numbers in Las Vegas, and some people, me included, feel perfectly fine of putting down $25 with a 3% success rate. Kind of stupid, but we do it anyway. There are some other numbers to consider, and Charisse just brought this up. If you are married, and there's a new report out there that says 75% chance that one of you will need some kind of long-term care. 75% chance you're going to deal with this. And there's a 25% chance that both of you are going to need some kind of care. It might be in a facility. It might be at home. It might be bringing somebody in. But as we age, we're going to need some help. And the cost of that kind of help is really escalating. $8,000 to $10,000 a month in some cases. It can eat up your retirement money very quickly. So, Charisse, this is as big or even a bigger threat to our retirement than the stock market is. So we should be talking more about this, but people go, I don't want to talk about that. I understand you don't want to talk about that.
Right.
It's depressing.
Yeah.
I mean, my
It
mom's
is.
in one of these facilities, and it's depressing, okay?
Yeah.
But we have to talk about it.
We do have to talk about it. I mean, I just had a friend who had to put their husband into the nursing home, and it was the hardest thing because you don't want to have to do that. And it wasn't the money is the issue. It's like the heart, like, oh, my spouse is going to go in a nursing home now, and I can't take care of him at home. But hey, there's a cost here. It's $10,000 a month. And where does the money come? Did you buy long-term care insurance for that? Did you buy life insurance? You can accelerate the death benefit, or do you have enough nest egg? You can pull it off the top of your portfolio and it not change the way that you live if they were to pass away. So you have to come up with a plan. And so a lot of people don't know this, Randy, but when you go into a nursing home, you have to spend down your assets. People do worry about that. Some people think Medicare is going to cover that, and they're not. And so you have to start figuring out where those dollars coming from. And a lot of people say, well, Sharice, the Medicaid can take care of me. But you have to spend basically all your assets down. You can keep one car, you can keep one house, and about $150,000 in assets-ish, depending on what state you're in. And so that could leave the surviving spouse financially destitute in the house. So in 2005, a new law came out where you can start doing these like compliant annuity trusts out there. They call them Medicaid trusts, where you could typically, the surviving spouse and house could save on average 50 to 60% of the asset, so that it doesn't all have to go to the nursing home, which is a nice thing. But there's such myths out there. And a lot of people are like, well, I can gift all my assets away over the next 5 years before it happens. And then Medicaid has to cover 100%. I have yet to find too many people that haven't met with the elder attorney and planned for it, get it right, because they're going to come back after those dollars anyway. So there has got to be some sort of plan when it comes to what if I go in, because, you can go into a nursing home and be incredibly healthy, but it's your mind that has gone. We have dementia. I had somebody in a nursing home for nearly 18 years, healthy as can be, but it was because the mind took over. And so thank goodness for our elder planners, and thank goodness for some cash saved and some long-term care planning planned ahead of time, because that spouse was still alive visiting his wife in a nursing home, and he was 90 years old. Right. And she was in her 80s. It was years ago when I met this couple, and it was interesting because I didn't know that. Right. And here's some cool stuff. We are going to have Empath Hospice, the CEO, come in and talk about hospice and what they do there and the misconceptions, because a lot of people think somebody goes into hospice and they're going to have 60 days before they pass away.
Not true.
But that's not true. A hospice is, a place for you to learn about how to care for your spouses or family members that are in these situations. It's a caring unit. There's so much more. And Randy, you have quite an amount of experience. But what I did not know about what is happening here locally is that there are classes and workshops that you can go take locally at Empath here, hospice, and they'll teach you all the things you need to do for your spouse and what are the next steps and all this stuff. It's really neat. So I want them to come on and talk about what they're doing and, how to take care of the grandparents. And I don't know anybody locally heard of the Nancy Reinhardt dementia education program, but it's fantastic. I'm about to go through it and then have our speaker come in here.
Well, we want to be kind of that place where you can learn or give you some of the direction that you need, not only just financially. I mean, this kind of speaks to, Sharice, who you are and what you do. And yes, we're going to talk about investments. And yes, we're going to talk about tax strategies. And yeah, we're going to get you taken care of as far as that is concerned. But there are things that Sharice does because she's a retirement planner, because these are the issues that you're going to be dealing with, that we need to help you with some education. And this is not anything that Charisse gets paid for. This is part of what she does.
And you know what? I want to learn it with you.
Yeah.
Right? This is why I know so much stuff, because I'm going to go in there and I'm going to get educated, right? And I'm going to help my clients. And it's just, I just want to walk the walk. And all of our staff and our advisors, they all want to walk the walk with you and experience and be able to educate you at the same time, because we come from an educational heart here at Zinnia Wealth. Like, we just want to educate and make sure you guys are having less hazards as you're stepping into these situations.
Yeah, I've been dealing with my mom with this for 5 years, and to have somebody and that's what we've done. She's in hospice, and to have somebody who can tell me, okay, all of a sudden she can't walk. What does that mean? How does this mean she's close to death? No. What is she? Her language isn't there anymore. What does this mean? How do I best communicate with her? All these different things. It's really important. So give us a call. Let's talk through it. I know that this is a hard topic to even approach, but it is something that we need to talk through, not only for you, but maybe we can support you with friends, relatives, spouses, grandparents, all that kind of thing as well. Give us a call at Zinnia Wealth. Our number, 833-368-3680. Well, on a kind of a fun topic to change the tenor of the show here, Bill Murray's golf event has been going for about 25 years, and it happened last week. A golf tournament in St. Augustine at the Golf Village there, where they have the Slammer and the Squire and King of the Bear and all those great golf courses.
And the Caddyshack restaurant.
And the Caddyshack restaurant, that's right. For 24 years. Next year will be the 25th anniversary.
So much fun.
And now you got to golf with Bill on a couple of occasions.
Yeah, Bill and his brothers. But Bill is hilarious. He's actually more down to earth than you would think. A little quirky and pretty good at golf. And when he brings his massage therapist with him, that's interesting. But so was able to, ask some questions, talk to them, and just a fun group, just raising money and brothers teaming up. It's, met mom, met the sisters. Actually, my room was right next to their room. I'm like, hey guys, awkward.
I love it.
And they're all piling in there. But so they always have some fun stuff to say.
Well, each year we go, and a part of it is we get to sit down with Bill and the brothers and fire some questions at them and talk about movies and that kind of thing. So I thought, what the heck? Let's ask a financial question. Okay?
We have to every time. They are like boring, but this was a fun one.
But it was fun. And I said, look, guys, I mean, one of the things that Charisse does is help people with fees and cut down on fees in their life. And we've already been experiencing a lot of fees just getting here. Airport fees, baggage fees, hotel fees, all these different. So I asked the brothers, what is the most irritating fee in your life? Here's Bill and his brothers.
Sometimes when you check out of a hotel, you get a parking fee when you don't have a car. That's to me is the most surprising.
Resort fees at my family's houses.
Well, it's got to be overdrafting, right?
Okay.
Yeah. No, I hate to be kicked when I'm down.
They're so funny. That's so...
Resort fees when I stay with my relatives. That's awesome.
That's awesome. Overdraft fees when I'm down. They're just funny.
I'm sitting in front of all these millionaires and he says overdraft fees. Okay. All right. So this is really something that you talk about and you help people. I mean, baggage fees are something I expect. I know I'm going to be in for that when I walk into the airport. Financial fees are something that I don't expect and I don't see because it's kind of buried someplace in tiny little print in a prospectus someplace.
Yeah.
But Charisse, when you do your portfolio x-ray for people, this is something that comes out of it. Talk a little bit about that.
Yes. So we'll do a portfolio x-ray for every single person who comes in. So we do have to see your statements ahead of time and get them prepped. But we take a scalpel to your portfolio because we truly believe that in retirement, having 2 and 3 and 4% in fees is outrageous. But your advisor might tell you, oh, our fee is only 1%, but that's their fee. So if the advisor gets that fee, what does the custodian and the big group they're with get paid? So when you're working with the big banks and brokerage firms, there's a light bill they got to pay. There's employees they got to pay. There's these white ivory tower. There's leases they have to pay. So they got to get paid. So this is why we take the scalpel to the portfolio. And what we find on average is, maybe your advisor's charging you maybe 1.25%. But the internal fees can be 0.75 to 1.25. So if you're being charged 1 And then the internal fee is 1, that's 2%. There's always another fee that's always tacked on to some of those funds on top of it. So you go down to Fidelity office and you get a Fidelity mutual fund and you get a Fidelity advisor, 1% for the advisor, 1% for the mutual funds. I mean, it's astronomically expensive. I don't feel like every dollar in your portfolio should have a fee, right? And there should be a 0.5% fee on one portfolio, 1% on another portfolio, maybe nothing on the other half of this portfolio. So you want to split it up so you can keep fees down in retirement. Because if you're going to earn a lower return because you're now living on your income, why do these advisors feel like they can up your fee? It blows my mind, Randy. So you just need to know where you're at. Because if you got $1 million portfolio and we save at least 0.5%, maybe 1%, and you live 30 to 40 years in retirement, that's hundreds of thousands of dollars back in your pocket to do whatever you want, to gift it, spend it, reinvest it. There's so many things out there. And then some of these annuities out there. Oh my God, when I do an annuity stress test, I see 3.5% to 4.5% in fees on average. Good God, get out of those. Yeah. And some of you might be like, I got a penalty. No, I can get you out, and I can get you out without a penalty. The fees are awful out there in the financial services industry, and they don't stop. They're just still there. The Wall Street's there to get you, and it's just kind of how the platform works. So
we just had a conversation about risk level and how a boring 5% can probably be enough to have a successful retirement. But if you're fighting that uphill battle with fees, if you have a 4% fee on a variable annuity, which is not that uncommon, now you have to make 9% to make the 5%.
Exactly.
And now you're throwing yourself higher risk. And I mean, just plain thought there, let's cut down the fees so I can cut down my risk so I can have my boring 5% and have a successful retirement. But how would you know, Charisse, unless you do the math?
Exactly. Do the math, do the math, do the math. And I know you guys probably don't know how to do the math. So this is why when you come in, and we build out your entire financial retirement plan and the income plan and tax plan, we are doing the math. We're even doing the math on when to take Social Security. We're doing the math on exactly what Medicare plan you should have. And we're doing the math on exactly what kind of trust or long-term care plan you should build in. There are math equations to everything that we do, and you need to be in front of it so that you have minimal hazards as you're embarking through your retirement years for the next 30 to 40 years, especially if you want to save money, enjoy your money, spend more, and then make sure there's an inheritance at the end of the day.
Well, it's time to dig down on this and do some numbers. And as we say every single show, let's do the math on your retirement, and we will do that math for you at no charge. If you look at our website, you're going to see a gold box there. It says Complimentary Retirement Consultation. That's what it is. It's a free look at where you are, what you've saved, how much it's costing you, what's working, what's not working, what's holding you back. Are you headed for a tax problem? Let's get you that information. 833-368-3680. 833-368-3680. Or again, our website, zinniawealth.com, ZINNIA wealth.com. And the gold box there, it says Complimentary Retirement Consultation. Click on that, and you'll be on your way. Charisse, that is all the time we have on this one. I'll give you the last word.
Okay. Well, I hope by now you have been delivered flowers to your home by your special people in your lives, you moms, and somebody has made your grandma or mom dinner in the household, and you're doing no cleaning, and you're just enjoying the grandkids or the kids and the family, because this is the weekend that mom should be treated and just done up very well. So relax, enjoy. You deserve it. You special moms out there, we love you and appreciate you. So as usual, thank you for tuning in on this special day. Live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and/or categories usually do not deduct transaction and/or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.